If you have 20 stocks or more in your account, honestly, your brain is going to explode because it's going to be information overload. It's just way too much to follow. So there's actually a lot of common stock market myths out there that I'm going to go over with you guys today because I see a lot of people losing a lot of money because they are investing based on what so-called experts are claiming about the stock market. So I want to talk a lot about what those common myths are and why you shouldn't listen to them. So one of probably the most common stock market advice tips out there is to buy the dip. And here's the thing. You don't know specifically when the market or that stock is done dipping. Yes, there are technical rules that you can follow. There's technical analysis. There's technical indicators that you can watch for to know when a stock or the stock market is done dipping. Now, do those principles always hold true? No, not necessarily, because a stock can go down, a stock can go to zero. It can keep going down. You never know. So there is a lot of risk in the stock market. Yes, of course there is, but there's also a lot of reward. So my advice, if you're buying the dip, is to at least just watch closely or maybe even put a stop loss on that stock so that if you do lose money or if the stock or the market does keep dipping, you at least can stop losing money at a certain point. Okay, another stock market myth that I want to talk about is buying stocks based on whether or not they pay a dividend. Now, there are a lot of stocks out there and a lot of companies that are pretty old, and a lot of them pay dividends, yes, but a lot of companies will pay dividends based on the fact that their stock isn't moving a lot. And so they're going to pay dividends to attract a lot of buyers, just knowing ultimately that the only thing attracting them to that stock is the fact that they pay dividends. And dividends are not going to make you rich. If you watch that video that I did recently, it's all about how dividends will not make you rich. So what I tell my clients is never buy stocks based on the fact that they pay dividends, because some of the best stocks don't pay any dividends. And wouldn't you rather make a lot more money faster with a stock that doesn't pay dividends versus a stock that either goes down or isn't going anywhere and just pays a flat low amount each month? Maybe for some people who caution against risk and they don't have a high risk tolerance, sure, that might be fine for some people. But if you want to make a lot of money in the stock market, you're not going to get rich buying stocks just based purely off of dividends, or you're not going to get rich just on dividends. So another stock market term that I would like to debunk today is hold on for dear life or set it and forget it, which basically means someone is buying a stock and they're holding and they're going to keep holding in hopes of making a big return 5 years, 10 years, 15 years from now. Now, with some companies, specifically, maybe, I'm not saying this is always true, but sometimes, or a lot of the times, the Magnificent Seven stocks, sure, those stocks you can probably hold for 5, 10, 15 years and make a lot of money. But there is no telling what is going to happen with that company. There is absolutely no telling that that company could very well go bankrupt in 2 years, and that stock could go to zero and you could lose everything. So hold on for dear life, set it and forget it. I highly recommend you do not take that approach and really stick to a strategic plan, a strategic profit-taking plan, meaning you know how much profit you want to make in a stock every time you invest, and always have an exit plan. I always tell my clients this, always have an exit plan before you get into any stock. So another stock market myth that I want to talk about today that could basically cost you a lot of money is when they tell you to diversify across many stocks. Now, if you've been following me for a while, you know that we are big in diversifying within sectors or across many sectors. And I do stand by that. However, I think sometimes, depending on the market cycle, it's good to be more heavily invested in some sectors and less invested in other sectors, and then vice versa, depending on the time of the year. But overall, diversifying across too many stocks is really hard to pay attention to because it's like your brain is just on overload, and it's so hard to pay attention to all of these different stocks and what they're doing or where they're going. I've done this in the past plenty of times where I have had way too many stocks, and sure enough, there were one or a couple that I wasn't paying attention to, and they just plummeted, and I was out a lot of money. You can still diversify in your portfolio. You can still diversify across some stocks, but I've always been a big believer of just buying more shares. And yes, this might be a riskier approach, but buying more shares of really solid companies versus buying some shares, just a small amount of shares across a ton of different companies or across a ton of different stocks, and not being able to pay attention to all of them, because it is virtually impossible. If you have 20 stocks or more in your account, honestly, your brain is going to explode because it's going to be information overload. It's just way too much to follow. So diversify, yes, but don't over diversify. And the last stock market myth that I would like to not necessarily debunk, but I would like to talk out a little bit, which is high risk, high reward. Yes, high risk, high reward. That is absolutely 100% true and possible when it comes to making money in the stock market. However, it's also a very risky approach. So if you're going to take the high risk, high reward route in the stock market, make sure, this might be obvious, but make sure that you have a high risk tolerance, because you can lose a lot of money really fast. There's this age-old adage in the stock market that says up the staircase and out the window. Yeah, up the staircase and out the window, which basically means stocks will gradually increase as they go up, and it's kind of a slow waiting game sometimes. But when they fall, and they fall hard. So again, like we say, put on your stop loss, watch that stop loss, because those stop losses don't always execute. So make sure your stop losses execute. And be careful if you are going to take that approach of just putting a lot of money in one stock. And, going back to my previous point, obviously you don't want to put all of your eggs in one basket. But high risk equals high reward. Yes, it absolutely does. But tread with caution, because you do not want to be on the other side of that stock if it crashes. And if you're not following market cycles, if you're not following seasonality, if you're not following what's going on with the administration, it could be a very dangerous road. So unless you have a lot of cash to burn, then I say, once again, tread with caution. All right, I'm Jody Jacobs. I'm the CEO and founder of Market Start. I hope that was helpful. If you guys have any questions or comments, feel free to drop them below.